assignment, make sure that when you're buying your tokens this month or the most recent ones that you've bought, try and check how much you bought at the same time last year, if you have the records. So you find that the tokens you're buying right now are more than what you bought at the same time last year, because the 15% reduction in electricity cost has been effected. So it's usually a base effect whereby you find some prices are going up, some prices are going down. And so a rise in some certain prices doesn't necessarily mean that the inflation rate is going to go up. But looking at where we are right now and the way the commodities have gone up, like cooking oil has even gone up. A packet of unga has gone up. Now it's around, I think, 240. So all that factored in, and looking at the effect of reduction in electricity and other commodities, then we might see for the first time in around 10 years, the inflation rate in Kenya hitting around above 8% in this month's inflation print. Then I wanted to give a historical, our history with inflation in Kenya. We're looking at the period leading up to the 2017 elections. We had a very high inflation, even above 20%. So I do not want to tie the high inflation to elections, but you find when you are nearing the election period, most of the time you find that there is a lot of wait and see attitude for most of the investors and for most of the importers, and so you find that it usually tends to increase the cost of commodities. So the red line is food inflation. So the rise in price of commodities, that is the food commodities. The one in blue is what we call headline, or what we are reporting. And then the one in blue is what we call non-food, non-fuel. So it's not related to food, it's not related to fuel. So if you look at that, then you find that food inflation has been on the rise, mostly when you're approaching the election period. Could be a theory to that, but I'm not certain. And then it goes down. We had the 2018 handshake, really cooled things down, and then has been rising again. And then we come to the pandemic period here. Inflation went down because the prices of, mostly the prices of fuel went down globally, as demand went down because and supply increased. So that means the prices of oil went down. Then we moved to the Russia-Ukraine conflict early in the year. That is what has been actually driving most of the inflation, because you find that Kenya is a net importer and most of our commodities are imported. And if you look at the next slide here, inflation is still a global challenge. So if you look at some of our key trading partners, we have the Eurozone, UK and US. They have a higher inflation than us. And so some of this inflation is what is imported back to the country. So some of the aspect of inflation is not really much to do with us. It's to do with the people we are trading with, whose commodities have gone up. So once we import the goods, then it translated to us. Now, if you look at this, you might say we are not doing badly off, but this is still high. 7.9 is still high. And if you look at CBK's recommendation, for them, their aim is to have inflation at between 2.5% to 7.5%. So if you look at the 7.9%, that means it's above the CBK upper target range of 7.5%. And the inflation getting here could get us into the wrong books with IMF, who have been funding us since COVID came. So because one of the conditions for accessing the IMF loans was that the inflation should not go above the target, the upper target of the CBK, which is 7.5%. But the reason why I suspect they have been lenient is because inflation it was thought to be transitory. It was thought that it would be something that should be short-term. But then as time has gone by, you find that it has proven to be sticky and it's going to be around for some time. So that's why you find that they might be lenient, because it's understandable. It's a global, another pandemic that you're currently facing. So the other thing I wanted to point out is Ethiopia. Ethiopia, there's been a conflict there. And this would catch your attention if you're a Safaricom investor, because Safaricom is starting operations in Ethiopia next month. And having an inflation of 37.7%, that would mean that Ethiopians might sacrifice spending on airtime or telco spending, because let's say even in your own personal case, in moments whereby you're broke, you tend to sacrifice buying airtime. You'd prefer maybe sending a call back or using WhatsApp call, or sometimes you even sacrifice, you don't have Wi-Fi, you sacrifice buying bundles. So imagine you're doing that with an inflation of 7.9% in Kenya. What will the Ethiopians do with 37.7%? So that is a key risk factor for Safaricom, even as they enter into Ethiopia. Another thing I wanted to point out is, so what do we mean by uncertainty? So what entails the current uncertainty? So we talked much about the high inflation. So we said that the local inflation has hit 5-year levels. The last time we got such a high inflation was, I think, in 2017, 2018. And also globally, countries are experiencing historical high inflation figures. Like I think in the US and UK, they are experiencing 40-year high levels they haven't seen in the last 40 years. And then the other one is elevated global oil prices. So global oil prices have gone, for the better part of the year or since the Russian-Ukraine conflict, have gone above $100 per barrel. And this is what has translated to the local effect for us, because for us, most of our oil is usually, okay, all of our oil is imported. And so this high, above 100 per barrel price is what is translating to the higher oil prices in Kenya. Now, and I think to note about the oil prices is that every 14th day of the month, what we call IPRA, the Energy, Petroleum and Regulatory Authority, reviews the prices of fuel, that is petrol, diesel, and kerosene. So, and one of the metrics they use is that they are setting, like next week, they will be setting the price for the 15th of July to 14th of August. And for that, they usually use the price for June. So whatever the price we imported oil at in June is what is going to be used to set the prices for July and August. So that 1 month lag is what is causing the high cost of oil locally. Actually, for this week, we had the prices of oil slightly go below 100 per barrel, but that wouldn't have much effect because it will be reflected in the prices for September. So even if it went below 100 for now, that means it is reduced. We would not feel it instantly because of the way we calculate our prices of oil. So the other one is the current, what we call geopolitical plays. So when I mean geopolitical is that there are some high-blown conflicts like Russia-Ukraine war and some rambos like the US-China. And also the Eurozone is not as calm as it looks. So all those geopolitical plays are what influences decisions, mostly investment decisions, and that is likely to drive how our asset classes perform. So an example of this is when the Russia-Ukraine war broke out, you find that investors in developed markets classify, you see Russia, Ukraine, Kenya, Africa, Middle East, they're all classified as emerging and frontier markets. So in terms of financial markets, Kenya and Ukraine are classified as almost the same, that is emerging and frontier markets. So the talk in developed markets among investment managers was that there's high risk in emerging and frontier markets. So that means then investors come back and take out whatever they had invested. And that is why you find that since the start of the year, or since the start of the Ukrainian war, you find that most of the NSC has been declining because the foreign investors are exiting, because for them, the term is emerging and frontier markets. So emerging and frontier markets are termed as the same. And that is one of the things that is currently influencing markets right now. Then you find local general elections. Locally, the election period or the election cycle brings about fear and uncertainty. And we have what we call a wait and see attitude from investors. So either foreign investors or local investors. Right now, from people I talk to or people I interact with every day, they are holding off on any investments they're going to do, at least until we know the direction you're going to take following the results of the election. So election is a key factor right now, and it's influencing some of the performance of asset classes that we have. Then the other one is financial markets volatility. We've talked about the NSE. There has been a decline since the start of the year, which has not been helped by the depreciating of the local currency. So these financial markets, maybe we can start with the local NSE. We talked about it being that the foreign investors are exiting. It means it's driving down the prices of shares, and that is being reflected also in our currency. Because when the foreign investors exit, they will be paid in dollars, and that is kind of straining the dollar reserves at central bank and with the local banks. And also you find that that aspect of foreign investors exiting is what is contributing to even local investors being fearful. So you find that you've been talks of dollar shortages in our banks, which has been there. And so this, by the look of it, is that the CBK insists there is enough dollars. The banks say we do not have enough dollars. So looking at it from a bird's eye view and, without much biasness, is that local investors or Kenyans are mostly net importers. We import most of our things. And so to import them, we need the dollars. And so the rise in commodities out there has made the number of dollars you need to import increase. And so what has happened is that local importers or local manufacturers have then started lining up their dollars early enough, like they are rushing for the dollars that are there. And so you find that a shortage appears, and that is what is even straining our shilling even further. Now, let us have a quick look at the market's performance. We're going to start with the shares market. So when you talk about equities, the same thing as talking about shares, the same as talking about stocks. So locally, in the first half of the year, we had the best performing stock being Crown Paints, followed by Samia, followed by Kind General. Then you have Portland Cement and Olympia Capital. And the market in 2022 was quite, say, interesting because we had most of these counters are often overlooked by investors. Even from my day-to-day interaction, for most of the investors I talk to, they want to buy the big chips, they want to buy the Safaricoms, the KCBs, the equities, the EABLs, and they often overlook these small counters. Let me call them small counters. So some of these gains by these counters have been driven by corporate factors. So corporate factors means that the shareholders are buying more. That is in the case of Crown Paints. So the majority shareholder has been, or in last year, it was reported that they increased their shareholding. And that for that specific reason, from where I stand is that most of the local investors and some of the foreign investors saw this as an opportunity and a stamp that the company is doing well. And that is why most people have been demanding it. And a company like Kind General has been mainly driven by declaration of a 3 shillings dividend and a 1-to-1 bonus issue that they did in around January, Feb of this year. And to put it into perspective, the Kind General share moved from around 27 shillings to all the way to 72 shillings, but then went back down to around 30, but now it's around 44 shillings. So it's a very interesting counter that we have observed. And we hope that the gain will be sustained and investors can continue making money on it. So on the other hand, we have the losers. So foreign exits have driven mainly the market. In this case, mostly I'm talking about Safaricom because Safaricom has been the largest loser at around 34.8. This has been reduced if you factor in the gains in the month of July. So July is a good month for them. Yesterday, they closed at around 27.95 from a high of around 44.95 in around 9 months ago. So Safaricom, it's not, we can't say there's something wrong with the company. The company is okay fundamentally, but then you find that because foreign investors drive our markets, then they have been affected in terms of the share price. That is why it's declining. Same things applies to Centum at some point, but Centum also fundamentally has some underlying issues. It feels like investors are not fully convinced about their large exposure to real estate and their lack of deals in terms of buying. They're only selling, they're not buying. And being a private equity and investment company, then that is kind of triggering investors to be fearful about it. Also factoring the death of Chris Kirubi, who was seen as the key deal maker for Centum, most of the investors now perceive the company as not having the ability to do some of the big deals that they had done before. Then looking at something like Liberty, that is to do with the insurance sector, it has not fully recovered from the COVID pandemic. So most of the insurance stocks are not doing well, apart from Jubilee and to some extent Britam, but most of the other stocks are not doing well. And then what WPP Scan Group, mostly is to do with corporate governance. They kicked out their CEO last year. They had a new appointment. They restructured the board. So those are some of the factors that are driving away investors, and investors remain fearful about them. The other one is the bonds market. We track the bonds market through something we call a yield curve. So the yield curve in this case is you're plotting the years to maturity for bonds against the rate of return that you should give investors if they were to hold those bonds up to maturity. So the yields have been going up. So the black one is the yields out of the close of last year, and this other one is the yields as of the end of June, that is 27th June. So if you look at it, is that since the start of the year, the yield curve has gone up, we call it steepening. So it has moved from this point to this point. That means investors are now demanding a premium for holding government bonds. So they are seeing the short-term risk in form of elections and high inflation, and the long-term risk in terms of maybe any possible effects that would come along brought about by the pandemic or any other macroeconomic factor that could be long-term, could be affecting us even 5 years from now. And so you find that the investors are now demanding a premium. They want more. If you look at the current issues by the CBK for treasury bonds, they have been going as high as close to 14%. So this is quite good for investors in terms of high returns, but then again, it poses a question in terms of government's debt sustainability, because it puts pressure on the government to accept expensive bids, and this could put additional pressure on the government's ability to pay back their debt, or debt sustainability for the government. Currently, the government has around 8.4 trillion in debt, which is equally split 4.2 for external and 4.2 for domestic debt. So this yield curve is for domestic debt. And if you look at KRA performance, they outdid themselves in the last financial year, hitting the target. They had a target of around 1.9, they did 2.1 trillion, and that's very commendable. But then if you look at our government fiscal discipline, the main issue has not been raising money. The main issue has been our expenditure. Our expenditure is the main issue. We have no issue with raising taxes, achieving the targets. We have no issue with raising government bond debt, but the issue comes with the expenditure. So if you could check the expenditure bit, then I think we'll be okay in terms of debt sustainability. The same for treasury bill performance. So going back to around 5 years back. So we are looking at the lead up to the 2017 elections. The rates were a bit still. There was not much movement. But if you compare that with the lead up to this election, then you find that the rates have been rising. So this could be contributed by a number of factors that were not there in 2017. One is 2017, the inflation was not that high compared to now. It was high, but not that high compared to now. But then right now we have factors of geopolitical events that are happening, global factors, logistics factors, and all those that are then making things even more complicated. So all those factors then, and if you look at government debt in 2017 versus now, there's more pressure now to meet government expenses. And so you find that that's why the government is even willing to accept higher yields. So right now the yields for the 3-month paper have almost come close to 9%. If you look at the 1-year paper, right now for this week, it crossed the 10% mark. And so this is expected to go up until at least the government can prove to remain sustainable in terms of debt sustainability. Then we can look at the money market funds. The money market funds, these are the rates as at the end of June. So these are the top 10 money market funds. Now, a very interesting thing is that money market funds invest in bonds and T-bills and in bank deposits. And so the rise in the yields on that side then have also translated to a rise in yields on this side. So if you look from the start of the year to now, most of the money market funds have their yields have gone up by around 1 percentage point. And so this then has been very good for investors who are considering stable source of savings for themselves. Then the other one is crypto volatility. So the crypto market has been one that has been talked about in recent news coverages, but then it's one very volatile. And the reason for the volatility is because there is nothing, or there's no underlying reasons. There is no underlying asset. So if you look at the government bonds, there is the government debt that is driving the performance of it. If you look at the stock market, you have the underlying security being the company, the performance of the company. If you look at the money market funds, the underlying security is the investment in government bonds and bank deposits. But if you look at Bitcoins and the other cryptos, there is no really underlying asset class that they are tied to. Mostly they're driven by market emotions. And so that's why you find that they have the volatility of moving from a high of $69,000 per Bitcoin in November of 2021, that is around, I think, 8 months ago, to a low of 19,000 in June 2022, like around 7 months later. Right now, it has started to recover at around 21 as of yesterday, the day before yesterday. The recovery is not as fast as the decline, but then this is one market that has sparked people's interest. But then again, it has been negative for most people, because for most people come to the crypto market thinking they're going to make a kill. And understanding the crypto market is very important. So for any investor, I would advise that they first understand the crypto market before getting into. So these are a famous quote by Warren Buffett, that he doesn't invest in what he doesn't understand. So for anyone considering the crypto market, I would advise you first take your time and understand it before you get yourself into it. So what's the strategy, given that you've seen the current events that are there in terms of the high inflation and the uncertainties that are there? So I have 5-point strategy that I would recommend to most investors. The first one is keep an eye on the overlooked counters. This is the stock market. So we have emergence of under the radar counters that have previously been overlooked by investors. We talked about Crown Paints and Can General, but on a year-to-date basis have gained around 30 and 25% respectively. And so this could be good ways to make money. You don't have to make money on the blue chips like Safaricom and the equities and the KCBs. And then you get to see the overlooked counters by following the markets. Make sure you have followed the most relevant people that share market information that will keep you informed in terms of knowing what is happening in the stock market. The other one is you consider the dividend paying counters. Currently, the best dividend paying counter is a counter we call Umeme. Umeme is the KPSC of Uganda, but it's also listed in Kenya. Right now, they are paying a dividend yield of around 22%, which is very good for investors. The other one is ABSA. We have Standard Chartered. We have NCBA, who have and BAT and I think BAT and Stanbic, who are above 10% in terms of dividend yield. So you should consider dividend paying counters, because even in periods whereby the stock market goes down, are usually compensated by the dividend that you're going to make or you're going to get. Then the other one is buy the dip. Yes, sounds cliche, everybody's talking about it, but then right now the foreign investors are exiting and they are driving the valuations of the local stocks very, very low. So for you as a local investor, is for you to take advantage of the low valuations. Like I'll give you an example of a client I had. So this client had bought Safaricom at 40 shillings, went all the way down to 23. But for them, because they were a prudent investor, they came back and told me, I think right now is the best time to do what we call dollar cost averaging. So you had bought at 40, it's now at 23, but you know there's nothing wrong with the company. So what you do, you buy more to bring down your average price. So for them, they bought more, they brought down the average price to around 30. Now it's at 28, close to 28. So by the time it hits 30, then he has broken even, considering the initial loss he had made and that again they're going to make right now. So if the counter goes above 30 and even goes back to 40, for them, they will have made more money. And also considering that Safaricom is a religious dividend payer, then you can always even benefit on the dividend. So look at the current low deep opportunities that are there and make sure that you're taking advantage of them. Then the other one is to consider the fixed income market. The treasury bills and treasury bonds offer a more stable and periodic and a better risk-adjusted return. And these interest or coupon payments that have been made can be reinvested into the other asset classes. So I'll give you an example. The fixed income market right now, the treasury bills and the treasury bond, the minimum investment is 50,000. So if you're able to start with your money market fund, you save up 50,000, take it out there and take it into a fixed treasury bill or treasury bond. They usually pay interest after every 6 months. So after every 6 months, whatever you're being paid, take it back to your money market fund, then it continue earning money. That's what we call compounding. So you don't have to start with huge amounts of money, or 1 million or above. No, you don't have to. You can start with your 3,000, with your 5,000 in the money market fund. Take it up 50,000, take it out of there, take it to the fixed income market, build another 50,000, take it out, take it to the stock market. And then whatever dividends you're paid in the stock market, whatever coupon you're paid in the fixed income, take it back to the money market fund, build again, add more to the stock market, add more to the bonds and T-bills market. So it's just some of those disciplines and strategies that you use as a small scale investor that enables you to get to the point whereby you find within a short period of time, you've accumulated a 300, a 400, even a million shillings in investments that you previously would not have done. And then the other one is, and maybe most people might not agree with me on this, is that avoid dead capital. So dead capital is those investments that take up much of your initial investment with no frequent or any returns that are coming. An example is land, idle land. So sometimes you find you go and buy a piece of land, leave it mostly because you're buying for speculative purposes, and then you do not plan to build on that piece of land, you do not plan to farm on it. There's no value you're going to add on that piece of land. For me, I usually recommend if you already bought one piece of land and you intend to build it, there's no need of accumulating more idle land. So take that money somewhere else, get the returns. Maybe you can use those returns to maybe buy that piece of land, but avoid investing in dead capital that is not giving you any form of return at the moment or even in the near future. Just to do a summary of it is that make a habit of tracking where you're spending your money, because that is very important, because it translates to where you're going to spend it. So sometimes this is something I even personally do. At the end of the month, I usually maybe sit down with a piece of paper, because most of the transactions are done on M-Pesa, check how I spent. Then I see this month I really spent on this, I should cut on this and focus on this and that. And I've done that for the last few months, and it has really helped me improve in terms of my savings, because I'm able to see points in which I made buying decisions that were not really needed. Like, we are susceptible to spontaneous buys. You might go out there, see a nice pair of shoes, you buy it, see a nice pair of trousers, you buy it. For the football fans, you see a good jersey, you buy it. It was not in your plans. So make a habit of tracking your expenses so that you can see where you're spending your money, and you can see in which areas you're spending your money. And then save for some of the rainy day. So by tracking your expenses, you're able to see where you're falling short in terms of your savings and in terms of your investments. And that could help you in realigning the way you're doing your savings and your investments. And then make use of the power of compounding. That is what I talked about in terms of build up your 50K in money market fund, take it to fixed income, get the coupon, take it back to money market fund, build another 50K, take it to stocks. And actually for stocks, you don't have to have 50K. You only need to buy 100 shares of any company. So if you're looking at a share like Safaricom, right now it's at 27.94, so it's 28 shillings. So you only need 2,800 shillings to start investing in Safaricom. If you look at a share like ABSA, it's trading at around 10.5 shillings. So you need 10,500 shillings to start investing in Safaricom. Yeah, so if you look at that, then you don't need 50,000 to start investing in the stock market. So you need just some discipline and knowing how to take advantage of the power of compounding to make you maybe a step ahead of your peers or the other people. If you're going to fall into some money in future, good for you. But then what you have, work with what you have right now and build a kind of a compounding network for yourself. And that is what is going to translate to a little bit of financial planning for yourself and some little bit of financial freedom from yourself. And then invest early in your life and make it a habit. So the earlier you start, the better for you. And then also make sure you learn more about savings and investing. So the fact that you signed up to this training, then that means you've started taking the right steps to learn about savings and investing. And then make sure you understand financial markets. So before you invest in stocks, make sure you do some more due diligence on what is required, the costs and everything else. Before you invest in bonds, before you invest in crypto, before you invest in real estate, anything. So before you invest in anything, first make sure you understand it, you have a basic understanding of it, and you're comfortable with it, and don't go blinding into it, and start crying later that you lost your money. So if you have an opportunity to learn more about it and avoid losing money, that is the best advice I would give. And then the last one is remember that cash is trash. So what I mean by this is that do not hold much of your money in cash. Okay, don't let and I know if you have bankers in here, they're not going to like this, but don't put your money in your current account or in your savings account in the bank. Don't give you any value. So if you've planned your monthly expenditures and what you have left is it should not be left into your bank to just I'm saving in my bank. No, it doesn't give you value. I'd rather even open a Sacco account, save it in your Sacco, because a Sacco can give you a loan easily than a bank would. So a Sacco would give you a loan based on your savings or what you have accumulated with them. And then you can take out the money and have it in a money market fund. You can take the money, buy stocks, you can take the money, buy bonds. So don't hold cash. Cash is eaten up by inflation. That's what I mean by cash is trash. So it tends to be eaten up by inflation. And right now the inflation is 7.9. So let's even call it 8%. So if you're making an investment, make sure the investment you're making is giving you more than 8%. So at least it can compensate for the rate of inflation. So if you hold the cash in your hands or in your M-Pesa or in your bank, then it's not giving you any value. In fact, you're going negative because inflation is going at 8% and your return is close to zero. So that is what I mean by cash is trash. And it's a mantra I live by, and it's something that has helped me be more disciplined in terms of my savings and my investments. So I would like to close it at that, and maybe welcome any questions that we have.
Great. Thank you a lot, Solomon, and I hope you guys have learned something from the session that you just had. And just to reiterate that investing is no longer an option for us. It's no longer an option for you. And you actually have a very good advantage in that you have a lot of time for you, because the younger you are, the better for you. So you need to think about investment and at least start thinking about taking that first step, that initial step, and you'll be on your way to financial freedom. So if sometimes people do not see the need to invest and think it of a niche for specific people with a particular skill of expertise, and then things like inflation come hitting you, and probably maybe you're working somewhere, or maybe you're employed somewhere, you have a business somewhere, you have an income. So if you make that income, if it doesn't match the level of inflation, and by inflation here we can even confine ourselves to the basic things that we buy. Maybe for a moment avoid looking at the aggregate figure of maybe 8%, and you look at the commodities that you buy on a daily basis, that is cooking oil and a loaf of bread. You realize the prices of those things in the last maybe couple of months or even years has, like for cooking oil, it has almost like tripled. And for sure, no employer will triple your salary in a year. So you can imagine if things continue that way, what will happen to your consumption? Like you won't be able to sustain the consumption that you have at the moment. So the only way to bridge that gap is to invest and get an extra income to cover up for the additional expenses that you incur in your consumption. So, and again, of course, you are never sure of how things will unfold in the future. And one thing I've learned with commodities and everything is that the prices keep on rising, but the rate at which these prices rise for commodities and goods, it doesn't tally with the rate at which your income increases, especially if you're employed. So your income keeps on slugging, but your expenses are growing exponentially. So the only way to protect yourself from all these things is by investing as aggressively as you can. And the good thing is that being a young person, you can take as many risks as possible. I actually wouldn't mind even if you lose everything, at least you still have time to come back up and try it over again and again and continue investing. That way you'll have safeguarded your later years, or rather your future later on in the years to come. So at the moment, I'll just advise you to do the most you can, minimize your expenses as much as you can. Yeah, and that way you'll be on a very good trajectory of getting financial freedom as early as possible. So thanks a lot, Solomon, and I hope you guys have been able to grasp something about this. And as you process all the information, I would request you, if you have any question, you can just speak it out, or maybe you can just put it on the chat here. We'll just respond to it. And given that we've just covered like an overview of the investment processes, strategies, and the assets that we have, I think in the remaining few minutes, I'll welcome Dennis to give you an overview of some of the things that we shall be doing as Finacol going forward, to ensure that you guys can grow in this, develop the skills, and continue to continue in the journey of investing, because it doesn't make sense for you to get this critical information and not put it into actual practice. The only way you're going to benefit is get to learn about this and put it into practice as soon as possible, or rather immediately, if I'll use such a term. Like Solo has mentioned about shares, you only need 100 shares of any listed company and you'll be good to go. So start off somewhere, get a money market fund somewhere that at least will cover, at least matches the rate of inflation. That means at least you've safeguarded your money, rather than keeping it in a bank and getting that 4% or 3%, which of course doesn't add any value, considering that the inflation is much higher than that. So please think about investing and start as soon as possible. Start with the most basic thing, and to make it through this journey, the easiest way to go about it as a young person especially is to reduce your consumption to the minimal, to live below your means and invest as much as possible. That way you'll have an upper advantage, because you can sacrifice the things that you maybe want at the moment for a better life, maybe later on in the future, because you don't again want to grow old and become a liability to the society. You need to create a life that will be adding value to those below you, not becoming a liability. Yeah, so I don't know, Dennis, you are ready. I think you can just give a highlight of some of the things that we intend to do in order to enlighten you people about investing and take you through the process. And hopefully you can share this information with those people that you care about, so that you can grow together with them in terms of investing and growing and accumulating wealth. We usually say as young people, we are at a stage where we are wealth creators and we are not wealth preservers. So we need to be aggressive in terms of sourcing for investments opportunities that will give you maximum return. Yeah, so Dennis, maybe you can just give us a brief, or rather a short highlight of what is to come, so that at least we'll be aware of it and maybe prepare for it. If it's worth your time, maybe you can consider, and then we can grow together. So in the meantime, in case you have a question, you can just reach out and we'll be happy to respond to you.
Thank you so much, James, for that. And also thank you so much, Solomon, for taking us through that session. It was a very insightful session, and I've also gotten to learn something. And now I think it will be best for us to first of all take questions from you guys. So if you have any question, kindly unmute your mic, and Solomon will be able to take on it. And I already see a question in the chat section. I already see a question in the chat section, and the question is from Kevin Kandie. What's the minimum time that one should gain profits after investing in stocks or money markets, incorporating with government T-bonds and T-bills, starting with a minimum of 50,000? Solomon, could you respond to that?
Okay, yeah. So thanks, Kevin. So what's the minimum time that one should gain profits after investing in stocks? I'll start with that part first. So for stocks, there's no minimum period you're supposed to hold it. So you can buy it like today. Right now we have what we call day trading in Kenya. Though on a return perspective, it's quite expensive. So you can buy it this week and sell it next week. Because it depends on the amount of return you've made, because stock prices change every day. Like every day the market is open, the prices are usually changed. So I'll give you an example of at the close of last month, Safaricom was trading at around 24 shillings. As of yesterday, it closed at 27 point, around 0.95. So that's around 4 shillings gain. And if you look at in terms of percentage, that would mean around, I think, more than 20%. Yeah, close to 20% gain in those few days from 1st of June to 8th of June. So there is no specific period for holding stocks. But then the best strategy for stocks is usually long term. So buy now and then just hold it if the company is fundamentally strong. Like Safaricom right now, the area it's trading at, the 28 shillings, is not its true value. The true value is above 40 or close to 40. So until it gets to around that point, then that's when you can sell it. And in that period of time, you're going to be getting dividends. Dividends are usually paid at least once a year. Sometimes you might be paid twice. So there's no minimum period for holding stocks, but it could be depending on your maybe your investment goals. Could be short term, you want to come in, get some returns. Some investors even have target returns. And they say, if I buy this stock and it gives me 15%, I'm selling it, even if it's going to go even higher. So the moment I get 15% from this stock, I'm selling it. So some investors usually come in with that target. And then once they make the 15%, they sell and then they buy again. They wait for another 15%, they sell and buy again. And in that period, they might be getting dividends. For money market funds, depends on the type of money market fund you're investing in. But for most of them, for you to get a good return, I recommend you hold it for like 1 year because of the power of compounding. But make sure every month you're adding to something, or not even every month, every time you have the ability to, you can always top up to what you had invested. Most of them don't have a period of time. You can even invest today. Once the funds have reflected, you can withdraw tomorrow. But then that is not good investment because there are some charges you're incurring in between, and the rate of return you've gotten is not enough to cover for those charges. So the best period is usually 6 to 12 months for money market funds. So for government bonds, go to up to 25 years, but then there's an option of selling it before maturity. So for government bonds, I really can't advise a favorable time period, but because for them, you can even hold them up to maturity. So for T-bills, they are short term. It's 3 months, 6 months, and 1 year. So those ones you can wait. For most of the time, you can wait. So, but for government bonds, it depends on your money needs. If you don't have any urgent need for money, you can hold it even for 20, 25 years. Yeah.
Thank you so much, Solomon, for that. I hope, Kevin, your question has been answered fully. Can you please confirm that, Kevin?
Yeah.
Okay,
Okay,
thank you.
that's good.
Okay. I see another question still on the chat from Anne Asava. And the question is, Solomon mentioned knowing the right people to follow. And the request is to share some of those people, and also for Solomon to share his handle. Solomon?
Okay, so for me, I'll start with the right people to follow. So there's a guy on Twitter known as Mango Capital. He shares some information. And then there is, I'll type them. There's the NTV journalist, Julian Amboko. And there's Abojani Investments, Finaco. I also see yourself sharing. And then, which other people? Mostly those ones, but once you follow those ones, they will lead you to other people that are in the market that speak the local language. Because you find that even in school, most of what we were taught about investment was taught in the, I would say, in the language of abroad. Yeah, but then you find people who speak it in the local language. So they break down things in the local understandable language. As for my handle, I'm on Instagram and on Twitter at Sentiguy. For Instagram, it's Sentiguy. For Twitter, it's Senti_guy.
Thank you, Solomon. Maybe you could also post it on the chat.
Yes, I'm posting it.
Okay. Thank you. And also, you can follow us on our handles at FinacolKE. That is for Instagram, Twitter, and Facebook. And then also on LinkedIn and YouTube, our YouTube channel. We are going by Finacol Consulting. So you can follow us, and you'll get some more updates about investing and also personal finance tips that you can use to add value to your life. Are there any other questions? Any other questions that you'd like to ask?
Hi guys.
Yeah, hi Oliver.
My name is Oliver. I just want to thank you guys for organizing a very well executed online meeting. It's been very informative. Cheers to yourselves at Finacle and to a very good presenter.